Hello everyone, welcome to the class Risk Management and Insurance 380, Personal Insurance Risk Management. In this class, we will talk about different kinds of insurance products, such as homeowners insurance, auto insurance, life insurance, health insurance, and we will also talk about some insurance products that you may not be very familiar with, such as your boathouse insurance and your boat insurance. Alright, let's get started. In this chapter, we're going to talk about the overview of this class. Basically, it gives you a foundation to start a class. If you have studied the RMI 370, the Introduction of Risk Management and Insurance course, you may find the content in this chapter very familiar. So, let's first take a look at the elements of loss exposure. What exactly is loss exposure? A loss exposure is something that may or may not happen, and therefore it associates with uncertainty, which is the principle of risk management insurance. So the loss exposure, by definition, is the chance or probability that some unfortunate event that causes a loss happens. Can you think about some example of loss exposure? I'll give you a moment to pause so that you can think about an example. Now let me give you an example. The probability that a tree will fall on a home and damage the roof would be an example of loss exposure. So when you look at any topic of your insurance classes, you may take two perspectives, from the perspective of insurance company and from the perspective of an individual. It is especially true for this course, the personal risk management and insurance. But it doesn't matter what perspective you take. There's always three elements of loss exposure, and these elements are assets that expose to loss, the cause of a loss, and the financial consequence of a loss. So the first element of loss exposure, assets that expose to loss, can be in fact categorized in many different ways. One way to categorize asset would be either it is tangible or non-tangible. Your asset could be either tangible or non-tangible. It doesn't matter which type of asset you have. It could be exposed to the following two types of losses. First is the loss to the asset itself. For example, if you have a house that is damaged in a fire, then the house would be the item with value. So if you have a homeowner's insurance, your insurance company will pay for the loss of your house. However, assets may also generate or accrue or sustain a value. For example, you could be renting out your house as a rental property. In this case, you are suffering from fire loss. At the same time, you're also suffering from the loss of income because of your rental property has been damaged. In this case, if you have an insurance, your homeowner's insurance is gonna pay not only the house value itself, but also the loss of income you have with the rental property. In insurance, there are two concepts associated with the cause of loss. The first is called peril. Peril is defined as the direct cause of loss. The other term is hazard. Hazard will be something that would impact the peril. So if you think about it, it's actually a chain event where the hazard caused a peril, where the peril caused a loss. So the difference between the peril and hazard depends on whether it is the direct cause of loss. Peril will be the direct cause of loss, whereas hazard will be something that influences the peril. For example, if there's a hurricane and a tree fell and destroys someone's car, in this case, what would be the peril here? Well, the peril would be the falling of the tree. What about a hazard? What is the hazard? The hazard would be the hurricane. So now if the car is covered by auto insurance with an insurance company, saying that any losses result from hazard of natural disaster would not be covered. In this case, the repair and replacement of the car would not be covered. However, if the insurance company says that any losses result from the perils of natural disaster would not be covered. In this case, the repair of the car replacement would be covered. And that is why in many insurance contracts, we often see the word hazard instead of peril. As you can imagine, it is extremely difficult for any natural disaster to cause a direct loss. Most likely, it would cause some other loss, which, as a result, become a direct cause of loss. Now, let's think about this question. Can the peril be hazard as well? So can it also be a hazard? Yes. In fact, perils are always hazard because hazard is one of the elements on the chain that cause the loss. But would the hazard always be a peril? Not necessarily. Only the direct cause of loss would be peril. The financial consequences of losses depend on what type of asset is exposed to loss. Obviously, if you have a car damage, depending on the car value, you may expose to different values of loss. Second is the cause of loss. Would it be a scratch on your car, or would it be a collision? What kind of collision it is? And obviously, there's also a severity of the loss, how big a loss it is. Next, we're going to talk about 3 types of loss exposures: the property loss exposure, the liability loss exposure, and the personal financial planning loss exposure. For all of these loss exposures, we're going to study it from these 3 elements: the assets exposed to loss, the cause of loss, and then the financial consequences of loss. So now, let's first take a look at the assets that are exposed to loss for the property loss exposures. Well, there are 2 types of assets that may expose to loss. There could be the real property and then the personal property. Like the term real estate, the real property includes land, buildings, any attached structure, plants growing on the land, and anything embedded in the land, such as minerals. All the other property is classified as personal property. So as you can imagine, real property can only be tangible. It cannot be intangible. However, personal property could be tangible and intangible property as well. As we indicated before, there could be direct consequences of loss and indirect consequence of loss. The fire damage of the house would be the direct consequence, whereas the loss of property rental value would be the indirect consequences of loss. And therefore, you may also consider financial consequences of loss as a reduction of the property value if it is direct consequence, and it could also be a reduction of the profit if it is an indirect consequence. The second type of loss exposure is the liability loss exposure. Liability loss exposure is a result from the potential reduction in the assets from the possibility of being sued or being held responsible for someone else's injury. all of your assets can potentially be exposed to the liability loss. It could be money or any other financial assets. A liability loss can result from property ownership. For example, if you own a house and someone trip and fall in your backyard, which could be your fault, in this case, you may be held liable for the loss. And the liability loss could also result from an action or inaction. For example, you accidentally drop a tool when you're climbing a ladder and hurt someone else, or when you're driving your vehicle and hit someone. They're all a result of an action. Liability can sometimes be of tremendous amount. For example, if someone is at fault in an auto accident, medical malpractice. Let's take a look at what kind of damages could there be. Well, there are three types of damages. First, it is a general damage. They are monetary award to compensate the victim of a loss. For example, if there's an auto accident, you damage someone else's car and you pay for him to repair or replace his car, and that money would be general damage. The second damage is special damage. It's a compensatory damage. So there's a similarity between the general damage and the special damage. Both of them can be evaluated by money amount. For example, if you hit someone in an auto accident and it turns out that he spent $10,000 to treat the physical impairment of his body, in this case, the money, $10,000, would be a special damage. So both general damage and special damage could be labeled with a dollar amount. However, the third type, the punitive or exemplary damage, would not be able to evaluate it by money. For example, if you involved in an auto accident, which is a result of you being drunk and drive, in that case, the court may award some punitive or exemplary damage. As a result of that, you may lose a lot of money. So punitive or exemplary damage takes a form of a dollar amount. However, it cannot be accurately measured. For example, the victim's pain and suffering after the auto accident are many times cannot be evaluated by dollar amount, and that would be the punitive or exemplary damage. The liability loss is very much different with the property costs. If there's no lawsuit, there will be no liability loss. For example, if you forgot to turn off your water tap, so it flooded the bathroom of your dorm. In addition, the water leaked to the dorm downstairs and ruined the property of the student who lived downstairs. Now suppose this guy lives downstairs, is your friend, and decided not to ask you for a replacement of the property and not to sue you. In this case, there is no liability loss to you because there is no filing of a lawsuit. However, in spite of that, your friend downstairs still suffers from the property loss. And therefore, if you look at the direct cause of liability loss, it is no longer any physical loss, but the claim of the liability or the filing of a lawsuit. The liability loss exposure is defined within the scope of a civil loss. The criminal law, however, deals with the conduct that endangers the public welfare, such as crimes of murder, rape, and fraud. Since such criminal acts are generally not the subject of insurance, civil law provides the legal foundation of an insurance. Therefore, if you murder someone, your liability insurance would not cover that kind of loss. There are three types of common personal liability claim. First is the tort liability. Tort liability means someone can sue you in a court because of the wrongdoing. For example, if you hit someone in an auto accident, the person who got hurt can sue you. The second type of personal liability would be the contractual liability. For example, if you hire a contractor to build a new house, if the contractor fails to fulfill what he's supposed to do, for example, he takes your money and run away, you then can sue him under the contract law. On the other hand, if you fail to pay him or her, he could also sue you, and that would also be under the contract liability. The third type is statutory liability. It is any liability that exists because of the passing of a new law. A tort is a wrongful act or an omission other than a crime or a breach of a contract that invades a legally protected right. There are three sources of a tort liability. It could be negligence, it could be intentional tort, it could also be absolute liability. Negligence is the most common cause of liability loss. To prove there's a negligence, usually the following four elements must all be occurred. First, you must have a duty of an act. And second, there must be a breach of that duty. For example, you need to have a valid driver's license to be able to drive. If you do not have a valid driver's license, there will then be a breach of that duty. As a consequence, there's an injury or damage occurred, and the breach of the duty will need to be the direct cause of injury or the damage in an unbroken chain of events. The second source of tort liability would be intentional tort. It's easy to understand, but there's one thing you need to be very careful about. Intentional tort doesn't mean the harm is intended. An intentional act itself can create liability. For example, you threat someone that you're going to shoot him with your shotgun. Now, even though you didn't mean to shoot him for real, the threat itself already assaulted him, and therefore he could very well sue you because there's an intentional tort from that person's perspective. The third source of tort liability would be the absolute liability. The absolute liability does not involve any proving of a negligence. For example, storing buckets of gasoline in your house, and the gasoline exploded and caused your neighbors injury. In this case, it doesn't matter if you're negligent, you will be held liable because normally having a lot of gasoline in the house would not be a normal thing people would do. So therefore, it constitutes an absolute liability. The possibility of a contractual liability arises when an individual enters into a contract or an agreement, such as lease of apartments, rental agreements for autos. The last type of personal liability would be statutory liability. It exists because of a passage of a statutory law. The most significant impact arises from the laws dealing with an automobile accident. In later chapters, we will talk in very detail about the regulation of different states. When the liability claim occurs, an individual or family can suffer from two major financial consequences in the following, and it can be huge. The first is the cost of investigation and defense. And the second type would be the money damage awarded if the defense is not successful or if the claim is settled out of the court. Which one do you think insurance company would help to pay? Well, luckily, insurance company will help to pay both the cost of investigation and defense and also the money damage awarded if the defense is not successful. Now, let's take a look at the third type of the loss exposure. It's the personal financial planning loss exposure. Now, there are four types, but all of them has something to do with the fact that your savings and your money is not enough to cover the loss exposures that you may face. Here are the four types of personal financial planning loss exposures. The retirement loss exposure, which is where your money is not enough to cover your life, everyday living after you have retired. The premature death exposure, which is not an exposure for the person who's already dead, but the loss exposure for the families of the deceased person. The third type is the poor health and disability exposure, which is easy to understand. Basically, you don't have enough money to do the necessary medical care or disability care. Finally, there's an unemployment exposure. You don't have enough saving to sustain you during the period when you become unemployed. Everyone would have his or her financial plan. Now, even a kid may also have a plan of his own, maybe to save enough money for a new Xbox. Now, even though saving money in the bank seems quite safe, it is virtually not very safe because there is certain personal financial planning loss exposures as the following. Namely, the interest of the saving in your bank is not enough to cover the inflation rate. First, let's take a look at the retirement loss exposure. Basically, you're considering that your retirement income or your saving is not enough to cover your daily life after you're retired. So your assets that are exposed to loss will be your regular employment income, either after you have retired or before you retire, those savings that you have accumulated. And also the related benefit, such as your health insurance, your saving, and also the Social Security benefit. Now, the primary risk you may face with the retirement loss exposure would be that your accumulative asset is not enough to cover the loss of income and benefits. There's also an indirect risk. Basically, you don't maintain enough resource to sustain a desired lifestyle, or you have underestimated the length of the retirement period. For example, someone may have considered that because his or her parents died at a young age, that he or she does not have a very good set of genes, so they're not gonna live to a very late life. So they may die young. However, their lifestyle may have resulted that they actually die very old. So during that period of time, they have used up all their savings. So that would be the underestimation of the length of your retirement period. So a good rule of thumb is do not start to withdraw your Social Security income at an early age, but try to delay it so that you could withdraw and 100% of your Social Security income. And that's how you can maximize your Social Security income. One thing that you need to be very careful about is, for most people, the Social Security income would not be enough to cover your daily life after you have retired. And therefore, it is always a good advice for everybody to save enough assets before they become retired. Now, this asset could be in any format. A good rule of thumb is, in an early age, you could invest your asset into a more risky assets. However, in later age, you want to invest in certain safe assets so that you're not exposed to your retirement loss exposure that much at an early age. But in an early age, you have all the time to fix the errors that you have made in early age. So you could invest in higher yield income. And the third type is the premature death loss exposure. What is a premature death? Basically, it's a death that occurs before an individual reaches his or her life expectancy. And the premature death exposure is even more severe if someone has a family that he or she is supporting. There are many causes of premature death, most likely accident, illnesses, and intentional taking of life. Now, from an insurance perspective, insurance is not used to cover the intentional taking of life, namely suicide, because suicide is a kind of moral hazard. Moral hazard is defined as knowing that there's an exposure and getting an insurance. So with an intention of committing a suicide and getting an insurance would be a kind of moral hazard, which would not be indemnified by your life insurance. However, there's a 2 years waiting period. Basically, after the 2 years, even though you commit a suicide, you could still be compensated by your life insurance. So that's the premature death exposure. What are the financial consequences of the premature death? Well, there's a replacement of income and the deceased individual's family needs. Now, let me give you an example. First, if a family is a traditional family whereas the husband works and have an income where the wife stay home and take care of their kids, would there be a financial consequence of a premature death of the husband? Of course, if he dies, the family would lose a regular income. Think about it. What if the wife, who does not work and generate income, but only stay home and take care of their kids, die? Is there any financial consequence of her premature death? You may think there's none. However, there is. Think about it. If the wife dies, what is the husband going to do with his kids? He would need to either quit his full-time job so that he can take care of his child, or he will have to hire someone to take care of his kids. Either way, he will have to pay or lose some of his income. And therefore, there is a financial consequence of the premature death, even the wife does not work. The other type of personal financial planning loss exposure is the health and disability loss exposure. For example, if you're ill, you need the money to cure. And if you're disabled, either it is physical disability or mental disability, you will need the treatment money. On the other hand, you also lose some of your income. So if you're chronically ill, you probably would not be able to perform your regular work, and therefore it prohibits you from getting a job. And therefore, you will lose some income as a result of that. Now, there are 4 types of disability. They're temporary partial disability, temporary total disability, permanent partial disability, and permanent total disability. The reason there are four types of disability is that the insurance company would have a way to pay for different kinds of disability. And of course, if it is only temporary partial disability, the payment could be very low or none. And when there is a permanent total disability, the payment could be pretty high. Okay, so let me give you some examples to illustrate these four types of disability. For example, for the temporary total disability, for the temporary partial disability, a broken finger of an NBA player may reduce his efficiency in playing the game. But if it does not prevent him from playing the game, it would be a temporary total disability, a temporary partial disability. For the temporary total disability would be a surgery of an NBA player's knee. It may render him from playing for a short period of time. But if he recovers, as soon as he recovers from his surgery, he can go back to his game. So he would have a temporary but total disability there. So the difference between a partial and a total disability basically lies into whether you will be able to perform your regular work. Now the permanent partial disability would be for a teacher. Losing his arm may prevent him from teaching if he uses the whiteboard writing as the main teaching tool. However, if he teaches online, he may still perform the teaching job, so it could be a permanent but partial disability. The permanent total disability would be for someone who couldn't wake up for an auto accident, so he's in a coma. In this case, he will not be able to perform any type of job. So in this case, he is considered as permanently total disabled until he wakes up one day and be able to perform his regular work. The financial consequence of poor health and disability is huge. There's a loss of income, and there's also medical expense. Think about this case. In a husband and wife scenario, any of them could be disabled. Now let's think about if both of them work and both of them would generate a regular income from time to time. Any of them become disabled would cost the loss of income of the disabled person. At the same time, there's an extra expense because of the medical treatment. In addition to that, the working person may have to take care of the sick person from time to time. So he or she would also lose their regular income. So the financial consequence of poor health and disability is really huge. Finally, individuals would face an unemployment loss exposure. The assets that exposed to unemployment loss would be the loss of your regular income, an employer-provided benefit. The loss of your income may result into insufficient for maintaining the worker's previous standard of living. A long period of unemployment can also substantially reduce or exhaust an unemployed worker's saving, so that the financial consequence of unemployment would be insufficient to maintain your previous standard of living, exhaust living. A recent study by the National Bureau of Economic Research indicate that job layoffs may adversely affect the unemployed workers' long-term health. Now, why would that be? There are two reasons. First, during the period of time when someone is unemployed, he or she may be very stressful, which would have a very negative impact on your health. And second, along with the loss of your job, you will also lose your good health insurance coverage if there's any. So it would also lose you the preventative care. So all of those factors will contribute to the negative impact on your long-term health. So as you may see, we face a lot of loss exposures in our life. how can we prevent those things from happening if those things are preventable? And if those things are not preventable, such as death itself, or disease, or disability, what can we do about it? Well, we could manage those risks. How can we do that? Well, there are 6 steps of risk management process. For those of you who have taken the Risk Management Insurance 370 class, Introductory of Risk Management Insurance, it will remind you of the 6 steps of risk management. Step 1, identifying loss exposure. Step 2, analyzing loss exposure. Step 3, examining the feasibility of risk management techniques. Fourth, selecting the appropriate risk management techniques. Step 5, implementing selected risk management techniques. And finally, monitor the results and revising the risk management program. So the thing you need to remember is not all the 6 steps, but you need to know which steps comes first and which step comes second, which is fairly easy to think about it. First, you need to know what kind of loss exposure you have before you can manage it. So identifying loss exposure is always the first step. And then you need to analyze it before you can select risk management tools, which would be the step 3 and 4. After you have selected, you need to implement it, and finally, you need to monitor it. And sometimes you need to revise the risk management program. Why is that? Well, because our life is dynamic. Every individual will have different stage in their life, and because of the different stage, they need to revise the risk management program. Let's take a more careful look at all the steps of the risk management process. Step 1, identifying loss exposure. How can we do it? Or namely, how can we know what kind of loss exposures we have? We talk to our friends, we talk to our family members, and sometimes our insurance agent would tell us what kind of loss exposures we'll have. The next step would be analyzing loss exposures. We can analyze the loss exposure into the following 4 dimensions: frequency, severity, total dollar losses, and timing. Let's take a look at the auto accidents as an example. Loss frequency would be, if you look back in the past 5 years, how many major auto accidents you have and how many minor auto accidents you had in the past 5 years. So as you can see, loss frequency has something to do with a specific time. And next is the loss severity. Were there many major accidents, or all of them are minor scratches? And also the total dollar losses, and also how long a time it takes for you to repair your vehicle. So that would be the analyzing of the loss exposure. The third step would be examining the feasibility of the risk management techniques. There could be risk control, which consists of avoidance, loss prevention, loss reduction, separation, duplication, diversification, and risk financing, retention or transfer. The difference between risk control and risk financing mainly is risk control try to tackle the risk itself, to prevent the loss from happening at the first time, or try to minimize the impact of the loss. Risk financing should always be your last resort. You should always try to prevent the loss from happening at first and try to reduce the impact of the risk. If you cannot do that, then you should try risk financing, either retention, basically save enough money to cover the exposure, or to transfer it to an insurance company, for example. So as you think about it, insurance is really a risk financing tool rather than a risk control tool. And as I said before, you should always do risk control first and use insurance as a last resort. Now, different people have different perspectives, and therefore, their risk management technique would be different. For example, someone may be very scared of flying, so he may drive or take a train rather than take a flight if he needs to travel. Now, in this person's mind, the risk would be an airplane crash, even though we know driving is actually more dangerous than taking a plane. But he would still rather drive. So that's his risk control technique. He's only controlling the airplane crash. So his strategy is not taking a plane at all. And he controls this risk by avoiding the risk. Now, if the same person, suppose he is still very scared of flying, but being a businessman, he needs to do a lot of international flying. So instead of avoiding the whole flying thing, he may decide to buy a big life insurance against this risk of a major air crash. In this case, he's then doing the risk financing. So as I said before, insurance itself is really risk financing. But sometimes insurance company would help to provide some advice in risk control. For example, your insurance company would advise you to use safety belt when you're driving. Step 4 would be selecting the appropriate risk management technique. So for the same risk, different entities will have different risk management techniques. For example, let's consider rainfall. As an individual, what is the strategy you would use to try to tackle the risk of raining? Probably nothing if you don't mind walking in the rain. Or maybe bring along an umbrella if you don't want to get wet if it rains. So the strategy you use is basically risk control. But if you're an event planner, you plan some sports events. Raining could be a big deal. It could result a whole cancellation of the event. Therefore, if you're hosting a major concert in open air, you probably have to cancel that, especially if there's a thunderstorm. In this case, you'll probably go to an insurance company and buy the so-called event cancellation policy. So the strategy you use is now risk transferring. The step 5 of the risk management process would be implementing the selected risk management techniques. You could do a purchase of loss reduction devices. For example, in big buildings, they would have a sprinkler system to put out a fire if there's any. You could always contract for loss prevention services. For example, you could set up an alarm system that is connected to the central station. So if there is a burglary, the central station would be alarmed. You could always set aside enough funding for retention programs, and that would be your saving. After that, you should always implement and continually reinforce the loss control programs. You may also select an agent or broker to deal with a specific loss exposure, and their advice could be loss control, and that has nothing to do with insurance or to purchase insurance. And finally, you will need to update a list of possessions that may be subject to loss. The last step, which is also very important, is the monitoring result and revising the selected risk management techniques. You will need to do this periodically to review the risk management program to ensure that it is achieving the expected results. For example, the recreational marijuana use is legal now in the state of Washington and Colorado. So in those two states, it is perfectly legal to have or even grow recreational marijuana in your house. And that actually creates a new risk to you. For example, if you live in any other states, you won't expose to such risk because it's illegal. You would not have any marijuana growing in your house. However, in those two states, you may have a plant of marijuana growing in your backyard. What if your neighbor's kids come to play with your kid while you're away and they consume that marijuana? You see, now you're exposed to some losses that is not exposed by all the other people in the other states. And therefore, because of the legal system changes and because our life changes, we will always need to monitor the results and revise the risk management techniques we've selected. Now let's take a look at the risk management techniques, the big two major types, risk control and risk financing. There are 6 ways to do risk control. First, you can avoid. Second, you could prevent. Third, you could reduce the loss. Fourth, you could separate the loss. You could duplicate it. And 6, you could diversify it. So first, let's pause for a moment. What is the difference between avoidance and loss prevention? Well, avoidance seeks to reduce the probability of the loss all the way to 0. But loss prevention seeks to reduce the probability, but not necessarily all the way down to 0. Then a question would be, why not seek the higher goal to reduce it all the way to 0? Well, sometimes it's difficult. Sometimes it's not possible to do it. For example, there may be some flooding area in the state that you're living in. What if there's a family who already live there and they're kind of poor? You cannot let them relocate because that's going to be an extra expense they have. So yes, they still exposed to the risk of being flooded. However, there's nothing you can do about it. So instead of avoiding the risk, which could be relocating the family, you may need to try to do some loss prevention. For example, to reinforce the levy you have in the state. The next step would be the risk financing. So if the risk cannot be controlled, or the risk can only be minimized, but not all the way reduced to 0, what can you do about it? Well, if the risk is relatively small, you may consider retention. If it is bigger, you may consider transfer. For example, everyone would have a valid auto insurance to be able to drive. The deductible section of your auto insurance would be a retention. Basically, you are retaining the first X dollar amount to yourself if there's a loss. For the rest of it, you're transferring to your insurance company. Transfer could be insurance or non-insurance transfer. Hedging would be a non-insurance risk transfer technique in which one asset, it could be money, is paid to offset the risk associated with another asset. For example, if a family agrees to pay a particular price for all of its home fuel oil in advance of the heating season, the family would be hedging against the possibility that the fuel costs would increase during the season. In this transaction, there is no insurance involved. Insurance is a very successful risk financing tool. There are 3 layers of the personal insurance. The bottom layer is the Social Security program, such as the Social Security benefit. You need to always remember the social program of insurance is always not enough for an individual, and therefore we need the second layer, the group insurance, and the third layer, the individual insurance. These three layers will address loss exposures of the following items. Now let's take a look at all of the five. Which layer addresses these loss exposures? First, property and liability loss exposure. Well, the Social Security program does not address that kind of loss exposure. So if you lose your house, lose your vehicle, or you're being sued, the Social Security program is not going to pay for it. And most likely, your group insurance would not help to pay for it. And therefore, the property and liability loss exposure is mainly addressed by the individual insurance layer. The retirement loss exposure, it could be addressed for all the three layers. And the premature death loss exposure and a health and disability loss exposure could also be addressed by all of the three layers. And as I said before, you should always try to maximize your individual insurance to address the retirement, premature death, and health and disability loss exposure, because the other two layers is usually not enough. Finally, there's an unemployment loss exposure. What about that? Well, your group insurance mainly not going to address that, but the unemployment loss exposure will be addressed by Social Security program and your individual insurance or your individual savings. As we mentioned before, insurance can be used to address the property and liability loss exposures. First, let's take a look at auto insurance. It helps to address the auto-related property and liability loss exposure. Let me give you some examples, and you can think about it, whether it is a property loss exposure or liability loss exposure. First, if you hit someone and injured someone else, and it turned out it's your fault, would that be property or liability loss exposure? Well, if the person sues you, there's going to be a liability loss exposure. If he doesn't, then you do not have any loss exposure. Second, what about your own vehicle? When you hit someone, your car is also partially damaged. Well, that would be a property loss exposure. What about there's a collision and your car got damaged and also his car got damaged as well? If it is your fault, what about the damage of his car? Would it be property or liability loss exposure? Well, the damage of his car will be your liability loss exposure if you turn out to be at fault. So the question is, what is the trade here? So when you purchase insurance, you pay the premium, but what do you get? Well, you may say the insurance payment. What if you never trigger your insurance? You're a good driver, you never trigger the insurance. What would that be? Would that be an unfair trade? You never actually use insurance, right? So what is the trading here when you pay your premium? Actually, you are trading the security here. You have transferred the uncertainty of an auto accident into a certainty. The certainty would be you're certain that your maximum payment here would be your deductible. You're not going to pay anything more if you have big enough insurance limit. Next, the homeowner's insurance. You could have a real and personal property loss exposure. You could also have a liability loss exposure. For example, if you suffer from a fire damage of your house, you would lose your house along with the personal property such as your TV inside of the house. If you did not maintain your house well and someone slip and fall at your front door, and that would be a liability loss exposure. So as you can think about it, you have liability loss exposure here with your home insurance. You also have a liability loss exposure here with your auto, with your vehicle. So how can we address both liability losses at the same time? So insurance invented something called umbrella liability protection. Basically, it's a liability protection beyond those offered by your homeowners and auto policies. So if you have exceeded the insurance limit of either your homeowners or auto insurance policy liability section, your umbrella liability protection will be triggered to pay for the rest. The next step of the retirement loss exposure is to address the saving plans, the pension plans, annuities, and social security programs. All these items will help to manage your retirement loss exposure. How do you finance the premature death loss exposure? Well, you could purchase life insurance. In fact, life insurance is one of the most effective ways for families to manage the premature death exposure. Why is that so? Because life insurance is something that you don't have to pay tax on. So you use after-tax income to purchase life insurance. At the end of the day, when the beneficiary got the life insurance proceeding, he or she would not need to pay any tax income. Your saving would also be a way to finance the premature death loss exposure. However, when the beneficiary gets your saving, basically in a format of estate, he or she may have to pay estate tax if the estate that he or she inherited exceeds a certain extent. The ways to finance the health and disability loss exposure would be your savings, your group health and disability income, individual health and disability income, and also certain social security programs, such as Medicare, Medicaid, and workers' compensation. Your unemployment loss exposure could be financed through either the state government-sponsored unemployment compensation program, which covers the involuntarily unemployment, so it has to be involuntarily, and approximately 2/3 of the hourly worker's previous income. So why not fully reimburse you, but only 2/3? Well, there's a moral hazard problem. If the state government give you your full income, how can you still have any incentive to go back to work? So only giving you partial income is actually incentivizing you to go back to your work. And where does the money come from? The source would be your everybody's tax money in the state. Sometimes labor unions would also help with the unemployment loss exposure. Now let's take a look at a common personal policy. What sections does a common policy have? Well, there are 6 categories. First, there's a section called declaration, following by the definitions, insuring agreements, conditions, exclusions, and the miscellaneous provisions. First, the declaration. Basically, it gives you the idea of who's the insured, what do we have in the policy, and who's the insurance company. So it would also tell you how much premium you need to pay. What is the policy number? Which, by the way, it reminds us that as an insurance claim, you would always want to refer your policy number, the name of the insurance company, the name of the insurance agent. What limit do you have in the policy? Where do you live? Sometimes mailing address is very important. Obviously, for your homeowner's insurance, your mailing address would sometimes be the same as the house. But sometimes if you have more than one house, the mailing address may be different. So for an insurance company, when they see the inconsistency of the location that they're covering and the mailing address, what conclusion they have? Well, maybe the house that they're covering is not the person's primary dwelling. Why do they care? Well, because, for example, if you have a lake house, that you don't always live there, so you don't have people to take care of the house. What's the result? Well, it may not be properly maintained. A result of that would be someone may have a burglary into your house without noticing. And maybe there's a fire that burned down a whole house without noticing by the insured. So in that case, your premium could be higher if you are covering your secondary house. The deductibles. So if you have a policy with a lower limit and higher deductible, you're going to have a lower premium. But if you have a policy with a higher limit, lower deductible, then you're going to have a higher premium. Policy inception and expiration dates will tell you when do you need to renew your policy, the name of the person or organizations whose additional interests are covered, and also the physical and edition dates of all the attached forms and endorsements. An insurance policy endorsement would tell you something that is not normally covered is covered in this policy, or something that is normally covered is not covered in this policy. So an endorsement basically changes the coverage. So how would the definition be for an insurance policy? Here are some rules. If you are using some everyday words, the insurance company is using some everyday words, so those words would have an ordinary meaning. If it is a technical word, it would use the technical meaning. If it is a word with an established legal meaning, then the policy would use the legal meanings. And also considerations will be given to some local, cultural, and trade usage meaning of words, if it is applicable. Insuring agreement is the promise of coverage that an insurance will make to the insured. It usually applies to the statements introduces policy coverage, and it could also describe statements introducing the coverage extensions, additional supplementary payments, and so forth. Here's an example of insuring agreement. Quote, "We provide the insurance described in this policy in return for the premium and compliance with all applicable provisions of this policy." Unquote. Some insureds would have this misconception that as long as he pays the premium, the insurance should pay. Well, this is untrue because there are certain conditions. For example, your obligation to pay, you report loss promptly. So if you suffer from auto accident and you did not report it to the insurance company very soon, you may not get paid. And you also need to provide an appropriate documentation for losses. You need to cooperate with the insurance company in any legal proceedings. Why is that so? Why would you need to cooperate with the insurer? Here is why. For example, in an auto accident, you could be hit by someone else, and someone else could be at fault of the auto accident. Now, when the insurance company has paid all of your losses, then the insurance company would then have a subrogation right. Basically, your insurance company can replace you to sue the party who's at fault. And therefore, you need to cooperate with your insurance company so then your insurance company can successfully subrogate for you and to get paid from the party who's at fault. And finally, you also need to refrain from jeopardizing the insurer's right. to recover from the responsible third parties. So why do we need exclusions in an insurance policy? Well, there are 6 purposes of an exclusion. First, it would help to eliminate the coverage requiring special treatment. For example, many standard policies covering valuable personal property would exclude coverages for loss exposures involving the property exhibit at a convention or trade fair. And for another example, many of your homeowners insurance would exclude the loss exposure of an earthquake, although you could always purchase an earthquake coverage to cover that. It would also assist in managing moral or morale hazards. So what's the difference between a moral and morale hazard? A moral hazard has 2 elements. First, an existence of an insurance policy. Second, the change of behavior. For example, if I know that I'm covered by insurance, I would drive less carefully because I know I'm protected. This would be a moral hazard. There is an exist of an auto insurance, and there's a change of behavior. I start to drive less carefully, see my behavior change. So moral hazard has something to do with, first, an existence of insurance policy, and second, the change of behavior. Now someone may have a question. Is a moral hazard always immoral? Well, this is not necessarily true. Let me give you one example. Now we all know that if we do have pretty good health insurance, we tend to seek medical treatment more frequently. Well, there's nothing wrong with seeing a doctor. There's nothing wrong to do a preventative care. But it's still a moral hazard because you have changed your behavior, right? You don't seek medical treatment that often if you don't have that good of a health insurance. And there's also an existence of a good health insurance coverage. So it is a moral hazard. But seeking medical care is nothing immoral. So moral hazard is not always amoral. There's also a morale hazard with an E following. What is that? A morale hazard is just some general careless. It doesn't matter if you have or have not an insurance. For example, you're just a careless driver with or without insurance. You would drive as less careful as you are. So that would just be a morale hazard. But if you know that you're being protected by auto insurance so that you drive less carefully, it would be a moral hazard because you have changed your behavior due to the existence of an insurance contract. So that is 2 very important concepts, the moral and morale hazards. They're not the same, and you should know the difference between the 2 and what are the elements for the moral hazard, the existence of insurance contract and the change of behavior. Now, insurance policy, the 3rd bullet point would be to reduce the likelihood of coverage duplication. So you may have a coverage elsewhere so that you're not covered in this coverage. For example, your regular homeowners insurance would have an exclusion of your vehicle. So your vehicle damage, if you hit your house with your car, would not be paid under your homeowners insurance because it's otherwise covered by your auto insurance. It also eliminates the coverage that is not needed by a typical insured. And for example, not everyone would have a very famous and expensive painting at their house, and therefore homeowners insurance is not designed to cover that kind of loss, so that everyday person would not pay high premium to cover those unnecessary risks that they never encounter. And it also eliminates the coverage requiring special treatment. For example, if you're a tax you help people to do their tax, and your homeowner's insurance would not help to pay that kind of liability because those professional liability would require special treatment. And finally, exclusions would assist in keeping your premium reasonable. The policy analysis include the pre-loss policy analysis and post-loss policy analysis. Basically, your underwriter would do the pre-loss policy analysis. It will look at the risk and see how much premium they would need to collect. The post-loss policy analysis basically is conducted by the claim adjuster. They would look at your policy provision and see if the loss is payable and how much of the loss is payable. The both pre-loss policy analysis and the post-loss analysis would help the insurance company to match their risk, which is the loss exposure here, with the appropriate policy. The pre-loss policy analysis relies on scenario analysis. It could help to determine the extent of the coverage the policy provides for the losses generated by a given scenario. So how can they know? They can try to look at past loss experience. For example, they will look at the previous 5 or 10 years of your auto accident, your traffic violation experience, so that they can determine how much premium to charge you for your auto insurance. And they would also look at someone else's past loss experience. So for someone who is a newcomer in the insurance market, they will look at some similar experiences. And there's also an insurance company's consulting here. There's always limitation with scenario analysis because it's impossible to account for every possibility. And that is the major fallback of the pre-loss policy analysis, because you're trying to predict something that has not happened yet. So it could be very difficult. Your claim adjuster of an insurance would conduct the post-loss policy analysis. They would use something called a DICE method. Well, of course, it is not rolling a dice. It's just because the first letter of the following 4 steps: declaration, insuring agreement, conditions, and exclusion. So that consists with DICE. The purpose of DICE would be to determine whether the underlying loss is covered. So the first step is the declaration, to determine whether the information provided by the insured precludes the coverage. For example, if the policy has expired. The second step is the insuring agreement. It would help to verify whether the agreement is still valid, the terms to define in the agreement. For example, whether you have paid your premium. Third step is the condition. It would try to verify if the insured and the insurer has fulfilled their duties. For example, the insurer's obligations to report the loss promptly, to provide appropriate documentation for loss, and to cooperate with the insurance company in any legal proceedings. An example of breach of condition will be: assume that an insured has a primary business running a furniture finishing operation in his home. If he fails to disclose this fact when obtaining his homeowner's insurance coverage, the violation of the policy's coverage condition, then the policy would not cover a fire caused by flammable rags used to polish the furniture. The last step would be exclusion, to determine if the exclusion is applied and whether the loss is a result of one of the exclusions. For example, an exclusion in a homeowner's policy would not allow the coverage to pay for claims resulting from earth movement caused by any earthquake, landslide, or so forth. And therefore, if you do not have any earthquake endorsement, the earthquake loss would not be covered. Here concludes the overview of the RMI 380, Personal Risk Management and Insurance. In the next chapter, we're going to start talking about the first type of insurance policy, the auto insurance.